discussing retracements and reversals. And this is a concept that is ultimately important in your trading. Now, the ability to point out a retracement or the difference between a retracement and a reversal is a great tool to add to your trading arsenal. Many inexperienced traders, along with some of the most experienced traders, are still unable to detect the difference between an asset's retracement or a potential reversal. Therefore, the focus of today's webinar is to provide you with the information and knowledge needed to accurately determine whether an asset is trading, that the asset is trending, is forming a retracement or reversal. Because remember, most of the time, assets are trading sideways because we have uptrends, we have downtrends, and we have sideways movement. Now, sideways doesn't have to be exactly so. You can have the price of an asset moving up higher than it was, but it's not trending upward. Okay. It's making no rhyme or reason. But when an asset is trending up or trending down, it doesn't just go this way. An asset goes through pushes and eases, pushes and eases, pushes and eases, pushes and eases. It's making higher highs and higher lows in an uptrend, or just the opposite in a downtrend. Now, as a trader, we have to understand that this is a push. This is an ease. This isn't time to panic sell and jump out of the market. This is a healthy move, okay? Because this is how a trend needs to move, because a trend doesn't go just like that. The question is, when it starts to make the retracement, when does this retracement become a reversal? When should you be exiting the market? Or if you're looking to enter the market, when should you be looking to enter the market? And you have to be able to decipher between retracements and reversals. Now, for instance, this was not a retracement. It was a strictly downward movement, push, ease, push. So let's start off with some definitions so that we know what we're talking about. A retracement is a momentary reversal that often occurs during a longer trend. Unlike reversals, retracements show a continuation of an opposing trend within the targeted asset's price action. As you can see in the picture on the side, there are a couple retracements taking place and occur throughout a prolonged period, because this is how this asset must move. So if you stop to think, price starts moving upward. Buyers and buyers and buyers and buyers are moving into the market. That's what gives the market and the price the potential to move upward. At some point, this asset, and this is a very simplistic explanation, but this asset hits a price that the early buyers had already set as their target price, because most traders go in the market with a target. If I can, buy the euro at 117 and it goes to 117.10, I'm out. I made my 10 pips. I'm happy. They don't follow the markets any longer, especially high frequency traders, professional traders, day traders. They're making many, many trades on small movements, and they get in a market, they get out of a market. So when hypothetically the euro had started moving from 17 upward, these buyers were buying. They had set 17.10 as a level in which they would be happy to get out. They made their money. Also, when it hit 17.10, a lot of the potential buyers moved to the sidelines. Okay, these were not people in the market. They were people thinking about entering. They're saying, okay, 17.10 is too high. It was trading at 117 just a little while ago. I'm going to wait to see where it eases back down to. So we've moved up to this point so far. So let me just clean this up. And I'll show it to you on real charts in a second. But so buyers pushed it up. We got to this point, and what happens here? The sells were triggered, and the other buyers who weren't in the market moved to the sidelines. That's all that happens. Nobody's upset about the trend. Nobody's saying it's not going to continue moving up. As less and less buyers are in and the sell order has been satisfied, the price starts to ease down. Okay, at some point, these potential buyers would move to the sideline and say, that's a good price. I'm going to jump back in the market. As they jump back in the market, they push this price up to a new high. And this is what the higher high is and the higher low is. Price makes a higher high. And at this point, the same thing occurs again. People who entered here were selling to take their profit. The other buyers have moved to the sidelines and the price eases down. So this is healthy. Okay. This is not healthy. Now, granted, price, if I had entered the market here, I was really happy. I made money, but it's not a healthy trend that's going to go on for a very, very long time. Now, the fact is, if you believe like I do that price is complete, first of all, price is the only thing that never lies to you and dictates the market. But the other thing is that price is random. We have millions of people around the world making millions of trades, all having millions of viewpoints, all being affected by everything from having a fight with the wife to getting stuck on the highway getting to the office to having coffee spilled on them. All affects their trading. You say that's a bunch of hogwash? Well, here's a trader. He trades for a big bank in New York. Okay. Now, on his way to work, he got into a fender bender. Nobody got hurt. Everything was over in a few minutes, and he got to work, but he got to work a half hour late. Okay. Now, that potential trade he would have made if he got to work on time didn't get made. So he was going to probably buy $1 million worth of the euro. It didn't get made. Now, granted, he's only a tiny little bit because the market isn't affected by one person or even one bank's trade, even though it's a lot of money. But imagine that happened there in Spain. There was terrible weather and everybody was delayed on the highway. Another big banker in London had a fight with the wife and he was just in a bad mood and he just wasn't himself today. Well, all of a sudden, all these little things affect the price of the asset. So an asset's price is random. There are only specific times, and these are called trends, that an asset exhibits non-random behavior. And when these assets are exhibiting this non-random behavior, we can make intelligent interpretations of price and make intelligent decisions. And every successful good trader only trades in qualified, nice trends. Now, reversals are temporary changes in assets trend that occur over a short period of time. Oftentimes, these reversals can last minutes, hours, or days. It just depends on what time frame you are utilizing for your charts. Reversals are oftentimes dramatic and do not represent a long continuation of the opposing trend during the asset's price action, like seen with retracements. Now, if you try to classify a retracement and reversal by rules, and it's really difficult to do so. I've never been able to use any rule-based definition. The fact is, it's something that you can use. You have to look at your charts. You can use indicators. You can look at your candlesticks. Okay. But you have to be able to see and feel whether it's a retracement or a reversal. Okay. Now, when a price reverses, the fact is we only have 3 alternatives. That's it. And that's if you're in the market. Now, remember, if you're not in the market, you're not even in the game. Okay. The first step in trading is you have to enter the game. You have to get into the market. You have to have an open trade. Having no trade open or having not an interest, you don't care whether it's a retracement or reversal. Period. End, because you're not in the game. The most important decision you make isn't entering a trade. The most important decision you ever make is exiting a trade. Because when you enter a trade, you're entering risk. When you're exiting a trade, is the only time you can make profit or loss. So when you're in a trade, you only have three options. You can hold through a sell-off, which could result in larger losses if the retracement turns out to be a larger trend. So in other words, say hypothetically, you're using Fibonacci levels and you see a retracement, it's come down through 38,250 and it's headed to 78.6. The question is, do you believe that the 78.6 retracement is going to hold and the asset will bounce off of that and go back up? Or do you sell now, take your small loss and get out? Now, you could hold it. Okay, it depends on how, what your capital is, how much leverage you're using, how big of a trade you've got going. Two, you can sell and rebuy if the price recovers. Well, that's one way. If it's going through a retracement, you can tell it's a retracement reversal, get out of your open trade. Okay, hopefully you got a little bit of profit and get out. And then when it reverses, jump back into markets again. But then you're taking double the spread. Okay, because you're paying the spread because you're doing a buy and a sell, and then you're doing a buy and a sell again. So you're increasing costs, so which might, well, it's definitely affect your profit, but might affect your overall profitability of the whole scenario. And then three is you could just sell and go away, but then you missed the opportunity when price recovered. And I can't tell you how many students tell me, the euro was at 117. I entered the market. It went up to 117.10. I could have sold a profit, but I didn't. It eased back down to 117.08, but I was sure it was going to turn around. It fell to 117.07, 117.06, and then I panicked and jumped out of the market. Well, it hit 117.05, and then it retraced and went up all the way up to 117.20. I was a fool. I could have wrote it out properly. Okay. Well, the fact is, when you sell permanently, close your eyes. Don't look at that asset, because you don't want to sit there and keep hitting yourself on the back saying, I could have, should have, would have. But what you should have, could have, would have been to properly identify the movement and define whether it was a retracement or a reversal and figure out what is going on. Now, traders have expressions for attempting to pick a bottom or top of markets. That's the other thing. When you're sitting there waiting to execute a trade, whether it's a sell or a buy, or you're looking to get out of a bad trade, okay, trying to hold out for the best top or the best bottom is like catching a falling knife. You'll never find the exact bottom. You'll never find the exact top. And it can be very dangerous. Now, keep in mind all the time that retracements are healthy. So let's go look at a live chart for a second here. Okay, here we have, it's the euro US dollar, but this is not yeah, it is up to date. But we're not here recommending any type of trade. Okay, I'm only using these charts because of what they show you. Now here we saw a beautiful uptrend moving here, and then what did we get? We got sideways action. So 90% of the individual cells. So now when we saw price moving up, it made its push and ease, and then it made a long push. 90% of the individual traders sell when they see new high and jump out. The pros do the exact opposite. Okay. Now, here we're starting to see the development of a higher high and higher low. So the price, let me get my marker on here for you, is doing quite nicely. It's here in sideways action coming off of a downtrend. Okay. We don't know what it is. It's still kind of a messy mess. But here we start to see higher highs, higher highs, higher highs. And then we get the breakout. It finally comes above our resistance level. and eases back down. So we have a nice push up, our first ease, which is our first retracement. And then it pushes back up to break the high of the prior high. But then we get a surge, because what it was is all of these guys that were sidelined are now saying, okay, when it bounced off of here, okay, we're getting in the market because we didn't get in the market here. So we're going to get off here. And they pushed the market up. And they start buying, and the market pushed up. Now here we get a very small ease, but each one of these times it's making higher highs and higher lows. So the only time you really have to worry about a retracement become a reversal is when the low breaks the previous low. Okay. Now an uptrend, if we had a trend line in here, we would use that to define it as, if we had a valid trend line, because price would have broken the trend line. But we need to understand how we enter, how we ride, and how we get out at the best time possible. Now, no matter how good you are, you would have never gotten out here. We might have gotten out here, but you didn't get hurt because we pushed up one more and then we went into a complete sideways mess. But how do we determine that this is a mess? Now, right now, we're looking at a live chart. This is, oh, actually, no, we're looking at last year. Now, will it go down, back down to here? Okay. Will it come back down to here? Will it come back down to here? Well, maybe you would have wanted to stay in the market and see where it went, because it never fell below this low here. But that's what I'm saying. You have to be able to look at a chart and see what it's trying to tell you. You have to see a price movement and be able to define whether it is a push and ease, a higher high and a higher low, or a reversal. I mean, just think, if you had bought here, would you have gotten out here? Well, here is the ease. Here's the push. But now when you notice, it can't sustain a new high. It can't make a higher high. Well, this would have been your exit point, because when price can't make a higher high, that tells you that trend is in trouble. And you should have been able to get out before here. But worst comes to worst, here when it broke your major, in this case, it was your support line or your resistance line, this is where you would have definitely exited this, because now it's going into a full reversal or a downtrend. Because we think, and it's very easy, and I try to explain this here on the, hold on, just let me get these markings up here. I try to explain this by using real charts, because we think it's very easy to draw this. Okay. Come on, marker. Okay. But in essence, in reality, this is what the market looks like. So it's easy for me to teach you push, ease, push, ease, push. But the fact is, this is not a well-qualified trend that I would have ever been trading in. Okay. And you'd be surprised, the market does do that oftentimes. And you're looking for as close to this as possible. I mean, here, now this is a live chart. Okay. And here, we can actually see a beautiful uptrend, push, ease, push, ease, and hopefully we're going to get a continued ease. We also have the fib levels supporting us and our support and resistance levels, okay, all holding us. Plus, we're staying above our simple moving averages. So we have a lot of things telling us that price should continue easing up. But we also have on here a chart pattern a rising wedge, okay, which was here and here, and we got something very interesting. We got a breakout of this wedge right here. Now, the question is, when we get a breakout, is it going to break down? Is this a false breakout or a real breakout? Now, it could have fallen down to our 38.2 retracement level and then continued upward, or will it continue upward that way? And this is the difficult calls. They're not easy calls. Now, I would have myself, if I hadn't seen the rising wedge, I would have gambled on this continuing, regathering its momentum and continuing up. But this breakout gives us a little bit to worry about. But where are we going to worry? Here or here. Now, one of the key pieces of information to determine whether we're looking at a retracement or reversal is volume. Oh, can't get, yeah, there we go. So when we're getting our breakout and is not supported by volume, that means the traders aren't looking at pushing it down to here. If it is supported by volume, because when price breaks down out of a pattern, okay, if volume increases like we saw right here, you're seeing a belief that it's going to fall, not reverse, but fall. Okay, we won't know until it gets down to the 38.2 level or down to this support level what's going to hold. But all of this is giving us things to think about to make decisions. So let's go back to my PowerPoint. So remember, retracements are healthy. The market in general can become tired of moving in the same direction. It takes lots of work and money to send an asset to higher highs. When the price gets too high, buying pressure runs out and the money dries up. When demand dries up, price begins to fall and causes the chart to head south. This causes security to become more appealing to the prospective buyers who believe the stock or the asset has the potential to move higher, but we're waiting for a better opportunity. Retracements can become reversals. Now you can see that after the retracement on this chart, which was a healthy part of the trend, the asset was unable to push to a new higher high. Instead, the security rolled over and created a lower high. And this is your telltale sign. When price cannot continue making higher highs and makes a lower high, or the opposite in a downtrend, we have to worry. A lower high is unhealthy, but it's not the end of the bullish trend. It is possible that after setting a lower high, the stock or the asset could retrace again, never setting a lower low, and then push above the previous high to a higher high. So when we get an asset that can't push to a higher high, the key will be that tells us, uh-oh, we got to watch out for trouble. If it's able if it makes a higher low and doesn't make a lower low, we have still some possibility that it's going to retrace again. But once the lower low is in place, your trend is over, and that is then called the reversal. Reversals are defined as a change in the overall trend of price. When an uptrend switches to a downtrend, is a reversal occurs. When a downtrend switches to an uptrend, a reversal also occurs. So, and remember, I'll reiterate again, you only have 3 possible scenarios. You only have 3 possible choices. And the choices are really your trading style. And you should have an independent set of rules on how you deal with retracements and reversals. What you believe will be the price that you need to exit the market, or that a retracement is coming in reversal. Do you panic at the 50% retracement level in a Fibonacci? Do you panic at a major support or resistance line? Do you not panic? Panic's the wrong word. Do you make your decision at those levels? You have to have, again, you can't just decide. You have to have a set of how you behave in general for all of your trades. Now, it doesn't mean every trade you have to do exactly the same, but you can't, because what ends up happening, if you don't have a set of rules that guide your normal everyday trading, and you just say, when I see this happening, I'll make my decision then, or I just look and watch my chart and I pop in and pop, you'll never be successful. You need to have some type of standardization, because otherwise you'll end up chasing assets. You'll let emotion come in and you'll chase your assets. So remember, you only have 3 choices. Okay. For me, number one, if in a position, you could hold on to your position. This could lead to losses if the retracement turns out to be a longer term reversal. Okay. So your rule number one is, at what point are you going to exit the market? At what point are you going to say, I'm no longer going to hope it's a retracement? Now, number two is one it's not even in my trading plan. Doesn't mean it's not in yours, but you could close your position and re-enter. When I close my position, I don't want to look at that asset, because I don't want to smack me in the back of the head and get mad at myself saying, you should have stayed in, you should have stayed in, you should have stayed in. No, I got out. Hopefully I got out with some profit. I'm happy. Okay. Now, maybe I'll come back to the asset a little later and maybe say, there's another opportunity because that trend's now continuing, and buy back in later. But I won't sell an asset and jump right back in the market with a buy. And then 3, you can just close permanently. Now, my rule of thumb is, 1, I have my points in which I get in that, or I decide it's going to get out of the market. When I'm not sure, when my indicators, my oscillators, my patterns, whatever I'm using to make my decision doesn't tell, I just close my position, especially if I'm in profit. But all of this gets combined together with your entire trading philosophy and strategy. Like I'm constantly moving my stop losses. The minute my asset moves in a profit, I've moved my stop loss way close. Moves up a little bit higher, farther into profit. Number 1, I move my stop loss up. Number 2, I probably close out half my trade. Okay. And then move my stop loss up again. Because each time I'm locking in the profit I made, because the market does turn against me, even for a little bit of a dip, I get stopped out. I don't care, because I'm stopped out with profit. So it's a matter of combining trading plans, strategies, and beliefs that give you this good trading ability, because reversals can happen at any time. Choosing the best option isn't always equal, so you need to be prepared. Now, what tools can you use? Fibonacci retracements, pivot points, support and resistance levels, trend line support and resistance, chart patterns, and other strategies. Now, I put fibs on my charts a lot. Now, we have whole classes in Fibonacci, the Fibonacci tool. The fact is, it's not something you can just blindly drop on a chart or use somebody else's. What makes you a better trader than the guy next to you is actually how you apply your Fibonacci retracement tool onto your charts. Because a Fibonacci retracement tool is, you're looking for the significant high and the significant low in the previous trend. Well, you have to define what you individually think of as being the significant high and the significant low. Now, there's all people with rules that I only take it when it's got a double candle with the 2 of. Okay. I look to see what price was significant on the top and what price was significant on the bottom, because it doesn't mean the highest point it made. It doesn't mean the highest close. Doesn't mean the lowest. That word significant is important. because Fibonacci retracement is an excellent tool for calculating the scope of retracement. I am a chart pattern trader. Okay. I trade predominantly from candles and wedges. Okay. From triangles and wedges. And I firmly believe in chart patterns. So like they're always on my chart. So I will use a breakout of a triangle as a significant clue. And support and resistance. Now, I believe in eyeballing support and resistance. I believe in going back through your price history and drawing all of your support and resistance lines on there individually by yourself. Because once you got them on your chart, they extend into the future. But again, what makes you a better trader than the guy next to you? Knowing the historic value of each one of those prices, and each one of my lines, color coded to tell me how long ago it was valid, how important it was, because a lot of times price will touch something, go off of it, touch something again, go off of it. Other time you would have seen significant price action at that level. Well, that makes you a better trader, and it helps when you're looking at retracements and reversals to see how major or minor is that support and resistance level. So as I mentioned, Fibonacci retracement are excellent tools. And you can decide whether you're 38.5, 50%, 78.6, or 23.6 level, whatever works best for you. Pivot points are something I don't use because I don't believe in them. Because a pivot point is a mathematical calculation based on the current price at the moment. And it's supposed to tell you what support and resistance are. There's pivot point charts. Okay, there's pivot point calculators. Okay, I just don't use them because I would much rather be eyeballing my support and resistance levels. And then, of course, we talk about trend lines. I was showing you that on the chart. Okay, because a trend line will show you the higher highs and higher lows, will let you see it perfectly. And then again, we can compare that with volume to see what is happening. Chart patterns and candlesticks are often used in conjunction with these trend lines to confirm reversals. So now keep in mind, technical analysis is a study of historical price performance to predict price performance in the future. Price is the only accurate measure of the market sentiment. Like I said, I'm a triangle trader. I firmly believe in using triangles. But the whole idea is being able to spot the difference between a reversal and a retracement, and having your set of rules, your set of trading rules, your set of strategies, everything interworking together, not letting your emotion, not saying, oh, look at that, it's coming down 38.6, but it looks nice, I think it's going to bounce up, maybe I won't do. This is not how you trade. What you trade is, okay, if it breaks 38.6, I close my position. Because you want to keep calm, you want to enjoy yourself, and you can find you'll do this by leaving your emotions aside and having these predetermined trading plans. So as a trader, you need to be able to differentiate between retracements and reversals. Without this knowledge, you risk many things such as exiting too soon, missing opportunities, holding on to losing positions, or losing money and wasting money on spreads. By combining technical analysis with some basic identification measures, you can protect yourself from these risks and put your trading capital to better use. So thank you very much for joining us tonight. I hope you learned a little. If you keep joining us every week, what you should do is jump in and join us in our 3-week course. We'll have our next class number 2 on support and resistance actually on Friday, and join us for that class, and we'll start teaching you. You'll learn how to do eyeballing, you'll learn pivot points, you'll learn how to, where support and resistance comes from, why it's important, how you use it, how you properly get it on your charts. So once again, thank you very much for joining us. Thank you for being part of the X Central family. And if you have any questions, just go to X Central, click on the live chat button, and somebody will be glad to answer your questions. Thank you very much and have a great trading week. Bye now.